Okay, let's do some Q&A from last week's Market Outlook. Let's see. This is somebody's screen name, Oh Captain, My Captain. This is from a movie with Robin Williams. However, does anybody know where that line is from? It is the first few lines of a poem by Whitman, Walt Whitman. And do you know who it was about? Anybody? Show of hands. Bueller? Bueller? It was about Lincoln. After Lincoln got shot. Lincoln, I think I spelled that right. All right. Mark, speculative. Do you think Powell may be thinking something along the lines of, when my successor comes in, he or she is going to drop rates significantly due to political pressure. My responsibility to ensure inflation as close as possible to 100% under control before that day. Oh, I see where you're going with this. You're thinking that he knows the person coming in is just going to cut irresponsibly, and that he needs to crush it first, so that he's more of a savior to the economy. I don't know, because there is a committee, right, that has to vote. Even if you have a chair that would like to see rates go lower, if the chair doesn't have the committee on its side, because it's all reached by consensus. Powell has said, even before every meeting, he has calls with each and every one of the voting members, and they discuss it and they see if they have a consensus. They see if they're on the same page. You still have a whole committee that has to vote. I don't know that a committee would vote recklessly. So I would say that I don't really know that that's on his mind. I would tend to think less so than more so. If he were thinking this, it may be the case, he would temporarily willing to overweight his mandate surrounding price stability and underweight the concerns surrounding maximum employment. It's going to get harder, I think, with the data. You've had 4 months now with, if you calculate the annualized rate on the 1 month, month over month, you're at the Fed target. The last 3 month annualized is below the Fed target. Supercore is well below the Fed target. You have recent graduate unemployment above the national level. I think for the first time it's a rarity, and by almost 200 basis points on that. Pushing up to like almost 6% when the national average is 4.2. You have elevated initial claims, not drastic, but elevated, and you have continuing claims climbing higher. And week after week, you're hearing more stories of how AI is reducing the need for entry-level employees, reducing the need for new hires because productivity increases, and even eliminating the need for certain jobs. Now, AI is not perfect, and it is subject to a limitation on how far it can go based on the current architecture that it has, but it is good enough right now to replace a lot of average employees. I hear people make the argument, hey, it's not 100% right, it's only about 80% right. Yeah, but no employee is 100% right. Most employees are anywhere from 60 to 100% right anyways. Employee hands you some output, there's always some fixing to do. So they're not entirely right either. Give me an LLM that's 80% right at $26.99 a month, or an employee at $100,000 a year. Guess which one I'm taking? So I think he's going to have a hard time with, if the data continues on the way I sense that it's going. I think we're going to see PCE later this week, very benign. We get a CPI next month. Nothing has happened this month that suggests that you're going to get a hot reading next month. If the month over month, I think, will be very low. The year over year will be high because you had inflation rise last year and then go sideways. Here you have almost no inflation. Year over year is fairly fine. So if it continues on like this, the base effects will show an increase year over year. But the Fed is smart enough to recognize that that's just math. That's not actually price increases, that's just math. It'll be the month over month and the last quarter annualized that'll be important. it will become more and more indefensible for the committee to not cut rates in the face of data that is suggesting that price stability, check. The job market is showing cracks and weakening. Student loan market is showing cracks already. The private credit market is showing cracks already. The interest on the federal debt is unsustainable on the path that we're on right now. All of these things I just checked off down here can be solved with lower rates, and the data, employment and inflation, give him permission. You can solve a lot and you'll have the permission. It will become harder and harder for him and for the committee to hold its course. I'm thinking July 30th is their next meeting. I cannot see why you wouldn't cut. I just can't see that. Even if you get a strong jobs report, let's say 200K, and inflation in July for June, the month over month comes in at 0.1 or even lower. Problem solved over here. If you're worried about the economy being strong, and let's say you have 5 months of no inflation, you're back to, look, the economy is strong as you say. Where's the inflation? Does it really need this? Are we not giving up on some extra investment and some extra job creation if we don't cut rates? Are we not giving that up? So I think it'll be harder for him to maintain that. Copper exposure. Why are you getting exposure to futures instead of the miners? Because one of the reasons copper prices are going up is because you're going to have supply less than demand. And the reason you're having supply less than demand, let's draw the surface of the earth over here, is you used to be able to just do these open pit mines because that's where the copper was, and you just had to dig deeper. Well, every time you dig deeper in an open pit mine, it raises the price. The ore, the average grade in the ore is depleting, so what you have to do now is, let's see if I can build this right, is you have to build your mine shafts to get underground to get to the deeper ore pockets. Let's get some shafts running off of here. Costs go up, so the price of copper has to go up, and that justifies going deeper and getting this ore down here. But even though the price of copper is going up, this is going up. So if you look at revenue, that is quantity times price, it's going to look great. However, your costs also will rise as well, and the net income is what belongs to us, is not going to increase at the same rate as the copper price will. So I just want exposure to this part of the income statement. I don't want anything to do down here. That is the copper price itself. Copper prices are going higher because the costs of getting the copper out of the ground are going higher, which does not necessarily follow from that logic that net income or earnings per share will increase. That's why I'd rather have just the copper price exposure. Less experienced, but also believers in copper with the gold miners ETF. I wouldn't go with the gold miners ETF. That is COPX. There is is it CUPR? CEPR? Copper. There is one that is just copper backed by futures, which is really the only way you can do it. CPER. I would look at that one. That is exposure to copper prices. Where are we now today? Pushing 495. I think the break of 525, 530. I think it's inevitable. Purely long play for 20 plus years. That's not how copper works. That's not how mining works. Usually they're 30-year cycles, 15-year bear markets, 15-year bull markets, long cycles. Because as the price rises, you get investment. And as these mines come online, what happens is supply starts to increase, which pushes the price down. And it takes quite a while for the depletion in these mines to get to the point where demand, because demand tends to increase, over time as GDP, global GDP increases, demand tends to increase. So you get demand that's increasing like this, and during the overinvestment cycle, what you'll get is you usually start off with a deficit, and then you get investment that starts to come online. Then it really comes online, and you have way too much supply, so it drives the price down, which kills investment, and then you have depletion over time, right? Which then drives the price down below demand, and this is probably where we were the last time we hit this cycle high, 2007. Usually these follow 15-year cycles, so 2022, we probably somewhere around 2020 investment started, but mines take 10, 12, 14 years to come online. If you're talking about greenfield mining sites, brownfield, 4, 5, 6, 7 years to come online. So the investments that were made here, it will start to, let's just take this and carry it on over here, it will start to rise, but it's still going to be quite some time before you get more supply than demand. Now, this is over time for copper. What you had, recently, especially with the rise of data centers, EVs, this what surprised me on the research I did is EVs are, for the first 5 months of 2025, at record levels globally. You have green energy transition, and you have data centers. So rather than this, what's happening is demand for copper is doing this, while supply is not coming online, but it will. You push that copper price to $6, $7, $8 a pound. Mines have reserves and they have resources, right? Reserves are economically viable. That's why they're called reserves. That's what the copper they have in reserve. Resources are copper that are geologically provable but economically not viable to take out of the ground because the cost to getting these would be too much. As the price goes up, some of these resources turn into reserves. So the amount of reserves start increasing, the amount of investment increases, because at $7, I'll go down another 100 meters, 200 meters, 300 meters to hit these copper deposits down here. At 7, it makes sense. At 450, it doesn't make sense. So you have depletion of reserves. So reserves over time start depleting. And as the price goes up, reserves start to increase because some of these resources then turn into reserves. That creates these long cycles. So if we think 2022, 2023, you probably have a bull market in copper for 15 years, call it 2037 to 2040. The estimates are that by 2035, some 200 mines will be fully depleted and there aren't enough mines coming online. The market is going to be structurally deficit till about 2030. That's a long bull run, but I wouldn't say 20 plus years. With the U.S. potentially entering another Middle East conflict, sort of doesn't look like it now. How should investors, no, it doesn't look like it now, for now. How should investors balance between safe haven flows into treasuries versus debt issuance risk? The U.S. doesn't have credit risk. It doesn't have credit risk. If you are afraid of the U.S., you got to be afraid of every other country, because every other country has a risk premium over the U.S. You got to be terrified of Japan. Japan's got way more debt to GDP than the U.S. does, but no one's talking about a Japan debt crisis. Why? Because its interest rate is almost zero. Its cost per citizen per debt is nothing compared to what it is in the U.S. I would say that the U.S. has really two big problems right now. It has a fiscal deficit problem, got to solve that, and it has an interest rate problem. You don't need these interest rates. I'm of the belief that we're going back to the zero line on the overnight rate. It is going to be the natural place to be, is the zero line. The wave of AI coming is going to be massively deflationary, and I'm not sure the Fed has even begin to count that into its forecast. It's going to be great for output. It's going to massively increase output, but that's why it's deflationary, because with all that output, it will put downward pressure on prices. I'm not sure. I think the narrative today is too much about too much debt, too much debt, too much debt. That's not the problem the U.S. has, because if that were the case, Japan should be bankrupt, but it's not. As a percentage of GDP, it has like what 280% of what the U.S. has, 280%, and no one talks about it. There's no issue with it. Rate yields have been going up, but only because they've been going up in the U.S. That sets the tone around the world. So I think it's just a matter of we got to get past this little hissy fit that everyone is throwing and realize that, wait a minute, there's no credit risk here. And there really shouldn't be a maturity premium on a liquid asset. You only have a maturity premium when your money is locked up for a period of time. But I can buy a 30-year treasury and sell it tomorrow, which makes it a one-day T-bill. If I do that, that's a one-day T-bill. So I can take any tenor and turn it into a money market fund by holding it for 3 months. It's just that I have, during that period of time, duration risk. So I should be compensated for interest rate risk, but certainly not for time to maturity. There should be no maturity premium on it in that sense. So that's got to come out of the market. Everyone's got to get that out of their head, that lending money to the government for 30 years is riskier than lending it for 10. No, it's not, because you can sell the 30-year bond in 10 years. It's a liquid market. It's a liquid market, people. As soon as we get past that narrative, I think we're going to be okay. So no, I don't see the U.S. wanting to enter into any war at all. And spend money. I see them wanting to spend money on boosting their military and building their military. But I don't know that they actually want to use it in a war. On an unrelated note, what advice would you give a high school student? Oh, that's a different question. Is it? Oh no, that is what a high school student wanting to get into finance. Don't look too far down the road. I mean, you want to get into finance, go to a business school. I mean, that would be step one. That's step one. And don't worry about, looking all the way down the road. Just say, okay, well, I'm going to go to a business school, find a good business school that's known for finance, that has some good finance professors, head there. Accordingly, with today's conference, the operation took months to plan. I heard that. Inconsistent with the president was blurry about the Israel initial strike. Well, you have the president. The president doesn't micromanage things. He doesn't call them up and say, start planning for this, start planning for that. I guarantee you, the military has a plan if China invades Taiwan. They have a plan. They already have a plan, multiple plans if China invades Taiwan. That is in sort of a dossier somewhere, without the president explicitly saying drop a plan for this, drop a plan for that. Contrary to what Trump says, he does not know more than the generals. He doesn't, and he doesn't know more than the intelligence community. They got a plan for everything. They got a plan if Russia attacks Poland, a NATO country. They got a plan if Pakistan launches a nuclear weapon. They got they all have contingency plans in place. So when this started in the Middle East, I'm sure somewhere somebody said, let's just have some contingency plans, because they got analysts. They got military analysts who say, well, there's this or there's that. Here's the weak spot. Here's this. Here's that. They all know where all the critical sites are. So I can believe that they had a plan. I bet you they have a plan to invade almost any country. Somewhere, someone's got a plan. Because what you don't want is something to happen and then you suddenly have to get into a conference room and develop a plan. These plans are already in place. Well, I wouldn't say in place. They're already on paper planned out, so that when shit hits the fan, they have 4 or 5 different plans that are already there. So, said that way, sure. For some of us who are not very comfortable trading copper futures, you think trading Wisdom Tree Copper ETC COPA with a TR expense ratio of 0.49 per year is a good alternative to futures. Yeah, if you're not comfortable with futures, don't do it. If you've never traded futures, don't do it. There are ETFs that do it. CPER, I think, is a good one. But there may be others, sure. Do you think trading oil is viable for a retail investor? I wouldn't do it. The oil contract is for 1,000 barrels, which means every $1 is $1,000 out of your pocket. Now there are smaller contracts than CL. CL is WTI. That's the big one. Oil shows itself willing to move sometimes $2-3 in a day. That's $2,000-3,000. Are you willing to lose that? You're probably willing to make it, but you have to ask, am I willing to lose it? Seems like prices are mean reverting, even though largely influenced by geopolitical and OPEC. Yeah, so oil is its own, especially, it can be sometimes regional. You really have to be in touch with inventory levels, the expectation for inventory levels, what refineries are operating, what refineries may be going on strike, where the oil is coming from, what refineries use what type of oil. It's a lot. It's not a market that I care to play in because it's big, and I don't understand enough of the fundamentals or have access to enough information to make meaningful trades on it. I myself would just avoid it. There are easier fights to win that I'd probably let me just new don't save that. Let's get a clean page there. Easier fights to win, which doesn't require as much work as WTI. Again, it's a big contract, right? Along the same times as the commenters curious to know why you no longer trade CPR. Oh, I already answered that. CPER. It's because I can do better on the futures. I have a large enough account. Like the amount that I'd have to buy in CPER. I actually have to put money into CPER, and I'd have to buy thousands of shares, right? But one contract, HG, costs me nothing. And I can secure that with T-bill, of which I got plenty of cash to do that with. So it's really costing me nothing. And it's for 25,000 pounds. How much of CPER I got to do to get that done, how much money I'm tying up, and I'm foregoing the money market rate at that point in time. So it just is simpler, cleaner, and easier. Not only that, CPER trades from 9:30 to 4. It's not liquid outside of those hours at all. You're not getting anything done. There's no overnight session for this little guy. HG trades 24 hours. If I need to get out, I can. And the options, their future options, the options also trade 24 hours. If I need to get out, I can. That's beautiful, right? I don't have to wait till 9:30 and try to unload 40,000 shares or 50,000 shares. Do you think finance professionals get more use to or use more cognitive domain emulators? Would they eventually be able to increase their own biological organic level of intelligence? There's a lot of papers that have come out over the last little while, 2 or 3 papers that have come out showing that students, they're not talking about professionals here, so we got to take it with a grain of salt. When I was a PhD student, I was always critical of academic papers who use students as their samples, because I thought students are a proxy for nothing but students. They're not representative of the general population. You're taking from the right tail of the distribution and saying, aha, look what we found. But they use students, which I guess is a good thing to use if you're studying how well they learn. Okay. They found that they give and it's fairly consistent across quite a few of the papers, is you'll use AI and you will not use AI, and you will generate a report, or you'll do some learning, right? You'll learn or you'll generate a report. What they found is AI generate a report. Can you cite anything from your report? And this is really, like 30 minutes after handing it in or an hour after handing it in. and it's almost nothing. Whereas here, they could cite from the report because, well, they were an active participant in the report. Here, they were passive. They simply wrote a prompt, they got the report, they said, here you go. Using AI to learn and not to learn, they found that these people scored better than these people on an exam. And then they switched them. They said, okay, now you use the AI and now you do it yourself. And they found that those who used the AI to learn, once they had to do it themselves, broke down. They couldn't learn effectively. Whereas these who learned, started using the AI, were okay. So yes, it will make you lazy. There is something to be said. Listen, you can buy, think about it this way. I think this is a really good analogy. I can buy a robot and I can send my robot to the gym. What's that going to do for me? What's that going to do for me? I can get my robot, let's just assume that these are all good, that they're perfect. I can send my robot to Taekwondo class. I can send it to Brazilian Jiu-Jitsu. I can send it to American boxing. I can get it to be the best fighter in the world. What's it going to do for me? Right? I mean, it's a great bodyguard, but what if my robot breaks down? Well, I don't know how to do any of that stuff. I don't know how to protect myself. I haven't learned any self-defense skills at all. It's the same for the brain. If you have your robot, your AI, do it for you. Write this paper, write this, write that. You fail to learn how to construct an argument. You fail to learn how to recognize relevant information from irrelevant information. You're not going to know what's true and what's not because you haven't read one thing and read another thing going, wait a minute now, these are contradictory. And then had to do the legwork to figure out which one of those sources was correct. The AI is doing it all for you and it spits it out. Well, how do you know how do you know it's correct? You haven't done the work, so you don't own the output. You're only renting it. The less effort you put into your learning, the more you're just renting that knowledge for a period of time, and that knowledge moves out at the end of the month. It sits in short-term memory and it leaves short-term memory. It never makes it to long-term memory unless you work out with it, unless you really push yourself with it. And it is uncomfortable. So is leg day. You ever see those guys who skip leg day? You can spot them with their little skinny jeans on. But it's uncomfortable. Of course it is. That's the point, right? If you're not uncomfortable, if you're not pushing yourself to a level of uncomfortness, there's a new word, to a level of discomfort, uncomfortness. I'm writing that down. A level of discomfort, you're not growing in whatever you do. So cognitively, you have to feel that frustration and that level of discomfort going, I don't get it. And it has to sit with you and you have to work it through. And when you do, you learn so much more than if somebody said, oh, here it is, it's this, this, and this. When you work it through yourself, because you'll go down a bunch of blind alleys, you'll now know what doesn't work. You will own that information for life. But the more you rely on AI, the less capable you become when you really need to get it done yourself. So from a social perspective, we should care about that. From a Machiavellian perspective, let them suffer as long as you don't. Because in 3 or 4 years, you're going to be a genius and they're not, right? It won't make you stupid. It will make you cognitively lazy, which presents itself as stupid. But you're not stupid because your brain probably has the cognitive connections to be very intelligent. But if you don't use them, you lose them. The more you use your brain, the more neural connections it attempts to make. And the more neural connections, it's the same as a model with more parameters. The more neural connections, the better and faster you are at solving new problems. So it is a tool which will have good outcomes and bad outcomes. Think of social media. It's a good tool for communication and keeping in touch, but it's also a bad tool because it can rot your mind and it can polarize a population by feeding you stuff that engages you. And what engages you on social media? Stuff that makes you angry. right? You become more engaged. So what does Facebook do? It feeds you stuff about how stupid the other side is and how smart you are with your ideology. And it feeds you stuff that reinforces your belief that you're right and they're wrong. This is what AI will do. It will make you cognitively lazy. Not stupid, but cognitively lazy. And cognitively lazy presents itself as stupid. That it's difficult to look at somebody and what they're saying and doing and say, well, they're not stupid, they're just cognitively lazy. It looks the same. But yeah, it will do that. It's not going to increase your own biological or organic level of intelligence. It will, if you rely on it more and more, without and thinking, oh, I don't have to do the hard work anymore. That's the beginning of the end of your cognitive growth. Do you think their own intelligence level will largely stay consistent, even by heavily using AI in their domain knowledge? You have to be an expert first. You must be an expert first, which means you must do all the hard work first. You have to do it. What's your source for the SPX forward operating earnings? If you look in the description box under every video, you'll see all the links. You'll see one for forward earnings. And just click on that, and it'll take you right to the source. You have said the candidate needs to have the ability to think at higher levels of analysis and evaluate learning levels, analysis and evaluation to pass the level 3 exam. This is true. Level 1 really tests your declarative, your conceptual, and your procedural knowledge. Declarative knowledge means facts. Level 1 is full of facts, right? Conceptual knowledge is, do you understand those facts, right? So there's a lot here. I'd say about 25% of the exam would be here, about 50% of the level 1 exam. And then you have procedural knowledge. Procedural knowledge is application. You know, given this population mean, this standard deviation, the n size of this, calculate the 90% precision levels. That would be a standard error, right? That's application, roughly about 25%. And more these are getting mixed, so that true calculation in level 1 actually is lower, maybe around 10 to 15%. And more this is getting mixed. When you get to level 2, you are not really tested on declarative knowledge anymore. You do have analysis. And by the time you get to level 3, you're really up here. Is that you're expected to understand what's on the page. It's not going to take any time to teach you some of the basic concepts and how to understand those. That's just table stakes at that point. Application, analysis, evaluation by the time you get to level 3. So you'll see a little bit of it at level 2, but unless you have some kind of metacognitive skills, you're really not going to get past level 3, as it should be, right? This is the same with university. If you can't move up to a metacognitive level by year 3, year 4, you should not graduate, as it should be. At least a good university would make sure that you are leaving there and entering the world living in the metacognitive realm. Otherwise, your future is limited. Have you seen the news about the recent embezzlement scheme from CFAI's former chief marketing officer? I have. His 2 employers, right? The CFAI, the Institute, and Pearson, apparently. Do you think this will have any implications on the prestige and reputation of the Institute, and by extension the charter itself? No. It seems like it could, right? Like, wow, look at this. It's the CFA Institute itself. But understand that there are people who are going to do bad things. And they have all day long to figure out how to get you. I've had employees that have stolen from me in the past. Is that a reflection on my lack of morality? You see that, you say, oh, somebody stole from Mark Meldrum. Mark Meldrum must be a thief. We look at this, oh, somebody embezzled from CFAI. That's unethical. The Institute must be unethical, right? It does. I think it would matter less for the ethical stance and more about governance. So they have a module for ESG, environmental, social, and governance. And then they teach us, it's like, well, how did the governance system break down? This is a governance issue. Every company is going to have bad people in it. Some research done years ago on this said that there's about 10% of workforce that will go out of their way to steal. Go out of their way, about 10%. So if you got 100 employees, there's about 10 of them that are going out of their way to steal from you. There's about 10% that would never do it, ever. And the middle is what's called opportunistic, and it ranges from, I need some stamps, or I need stamps. I'm dating myself now. I need some paper for my printer at home. I'm just going to grab some paper from work, something simple like that. Or I should be working, but I'm going to book my trip while I'm at work, and maybe you take 30 minutes of company time to book your trip. Well, you're still stealing from the company in the sense that you're, getting paid to do your own work. But yeah, 10% of your staff will go out of their way. They got all day long to think about how to get you. You're not going to be able to tell the difference between a good person and a bad person when you're talking to them, because the bad person's not going to say, by the way, I'm a pretty bad person. So no, I don't think this reflects badly on the ethical standing and the importance of ethics for the CFA Institute. What it does highlight is that these people are everywhere, even in a place like that. So they're in your organization. So what is more important here? This is not a failure of ethics. I don't think, I don't think that you can teach somebody like that to be ethical. I think you can teach them ethics, and I think they can pass a test on ethics, but I don't think it's going to change their mind one single bit. You're either going to be ethical or you're not going to be ethical. You either have a line that you won't cross or you don't. Period. I don't know that a course on ethics is going to change your mind about what you're going to do. And money, that changes everybody. Money is, if you want to know the true personality or the true individual, add money. Money is a magnifier. Money makes you more of what you are. So if you're a jerk and an asshole and that person wins a lottery, you're going to create a big asshole because that's what it does. This is not a PR issue for the CFAI in terms of their stance on ethics. It does bring into question their governance structure, big time. It does bring that into question. So, you combine declining enrollment along with a changing curriculum that brings up the question of why is it less rigorous, and why are you introducing more errors into this at the same time, along with a major breach of governance that goes on under your nose for 5 years. That calls into question management of the Institute itself. And I've been saying for some time, this Institute needs new management. It's not going in the right direction. It is a shrinking organization at this point, and that should be the only concern. But add this on, this does speak to something at management level. These people always exist. You're never going to get rid of them. You'll see that when you become a manager, or if you have a business, if you hire enough people, guess what? Some of them are going to steal from you. If you got 10 friends, one of them's probably stealing from you somewhere. That's just how it works. That's human nature. So no, I don't blame the CFAI for this. However, from a governance perspective, you got to say, how the hell did you get away with it for that long? Without anybody looking at it. I know somebody who was manager of a car dealership, and he did the same thing, because this is such a common scam. Why would you fall for it? It's such a common scam. So what this guy did at the Institute is he was director of marketing, and he could hire out other companies to do market research. So he set up these companies, And he had them do non-existent market research, put an invoice, and they would get paid because in his budget, he had the budget to get this done, so he did. This guy who manages his car dealership has a budget to get things done on certain cars. So when they take in trade-ins, these cars need to be detailed, they need to be cleaned, they need to do all of that stuff. So he set up businesses to have that done. And then he has these businesses invoice the car dealership, and then of course they pay, but those cars never get detailed. Tricky, right? This is an old scam. It goes back years. So the question here, I guess the bigger question is, how did you even let this happen? Right? How come these vendors were not vetted? Now, it did say he went out of his way to create bios, he created emails of these people, but still, you would still vet them. You'd still go through a process because this is a very well-known scam, right? Governance. Why am I going to learn governance from an institute that, has fallen victim to what is just such a common scam to have, right? That's a lack of oversight. Same with this car dealership. That's a lack of oversight because the owners of this dealership lived in another city. This is just one of the dealerships they had. They put a manager in place who was a snake in the grass, and this is what he was doing. A very common setup. Very common setup. So it doesn't speak to the Institute's ethics. It speaks to their lack of governance. And again, with everything else, I'm going on a tirade here, but I have been critical of the Institute for some time, especially with the new writings at level 3 that went ultra woke. If you saw the video I put up on YouTube about this, they were talking about wealth distribution, and in one reading it said an equal distribution would be ideal. Well, guess what? You'd have no wealth management industry if you did that, you fucking idiot. Now, I can swear. Okay, I've learned that from the President of the United States. So if you don't like my swearing, if you don't like my language, you gotta take it up with the President of the United States. He taught me that I can do that and that it's perfectly okay. Let's see. I noticed you reference beta frequently in your options video and often use it to make trading decisions. Well, you can use it. So if you're learning something, there are different techniques that you can use. It is one technique you can use. You can use that, yes. Being more of a fundamental investor, I couldn't help but wonder if historical beta is an accurate representation of future short-term volatility. Future short-term beta, if you will. Okay, so I'm going to stop here, and I'm going to ask you why. Why? Because you're making a statement, a proposition or a theory about something you'd like an answer to. Is historical beta an accurate representation of future, and then you're saying short-term volatility? Why do you think that historical beta would be a good proxy for future short-term volatility? That would be the first question I would ask. I'd want you to be clear on why you think that there's a relationship here, because I don't know that I would say it's a good representation of future short-term volatility. As companies age, their betas tend to get pulled. If this is the beta of the market, their betas tend to get pulled towards the market beta, especially higher beta companies. As they get larger and larger and larger, it's harder for them to move differently than the market. They tend to move towards the market over time. I calculated and graphed the 45-day rolling beta for Apple. So I would stop there and say, okay, how did you calculate the 45-day rolling beta? Using Excel slope function to calculate beta for Apple. And because you're saying that, so I want to make sure this is all part of, when you're in talking with someone and trying to answer questions, you first of all have to be clear that we both have the same picture in our head when we're using words. So I'm just, I'm not pushing back on you. This is just asking questions for conceptual clarity so that I know what you mean when you say it, and I have the same picture in my head that you have in your head. But if read that and I say, okay, to me it means this, and to you it means something else, then my answer to you may seem, you may listen to my answer and go, no, what the hell are you talking? This guy doesn't know what he's talking about. No, it just means that I'm talking about something else, right? So I'd ask more questions here. And notice historical beta over this time frame is very volatile. Well, on a 45 days, your sample size is what, 45? And you're using daily returns, so you're bringing a lot of noise into this, right? I don't know that daily returns are really a wise thing to use for beta. Weekly returns over a 1 year period, let's say, if you're using a 3 year period, you should really use the monthly returns. So that would give you 36 observations, which is greater than 30. So you can use those returns to set up distributions. But daily, you're really importing a lot of noise into this. Would love to get your opinion on using beta as a volatility gauge for short-term trading. That sounds technical to me, and I don't really get into that. I don't see why. One thing I did do years ago, which really was very useful, is I took, and this might help you here if you're thinking about short term. I wanted to split beta and do a split beta. So I took a stock's returns for, we'll call it 90 days, and I took the index's return for 90 days, and then I split them into two different columns. I said, okay, here are all the returns, paired returns on days where the market went up. Regardless of whether the stock went up, the market went up. And here in this column are all the entries on the days the market went down. And then I calculated a beta up and a beta down. And what I found was a lot of momentum stocks have beta downs that are low. So let's say the stock's beta is 1.2, meaning you got a growth stock versus a index of 1. On up days, you got to like 1.6. On down days, you were sometimes 0.9, right? Which means when the market is down, these stocks barely didn't drop as much as the market, but when the market went up, they really went up, and then the blended would be 120. So 120 understates its true momentum, because on days when the market went up, it had a much bigger beta than on days when the market went down. So you can do something like that, but as far as just a general beta, I don't know that I'd know how. You'd have to tell me how do you think that you can use it, as opposed to asking me if it's useful. You tell me why you think it's useful. Better place to start. From what I'm seeing, beta doesn't appear to be very useful in placing short-term trades. I would agree. Am I wrong? When you say short-term trades, the trade duration, your holding period is very short. I would agree with that. Am I wrong in thinking beta isn't relevant for short-term trading? I don't know. There might be a quant person out there that says, whoa, oh my God, you're missing the Johnson, Flipson, Wilson formula. I don't know. I made that up, but who knows what's out there? I don't know. In the past, you've mentioned how it's beneficial to specialize in one industry as opposed to being a generalist. I wanted to see why you picked REITs. And would you pick that today if you were starting over? I don't know why I picked REITs. REITs just seem to appeal to me. I understood the business model, right? It was easy to understand. I think that's probably why I took it, because I thought, I get it. I know what it's doing. You got space. This person needs space. That person's going to give you so much money a month, and they're going to sign a lease for a certain period of time. I get it. I get that business model. It just so happened that REITs ended up performing really, really well. So there was why would I go anywhere else? If I had to do it today, I don't know. See, the thing with REITs is your knowledge is cumulative, and it's monotonic. That's a big word, right? What do you mean your knowledge is cumulative and monotonic? REITs are fairly stable. Here, whoops, I don't know what happened there, but let's get rid of that. Let's take an apartment building. And we'll just make it a Soviet-style apartment building with no balconies. How's that sound? And 5 years from now, you know what? I know the business model on this thing. These apartments will rent out. This building exists here. I know how to value it. 10 years from now, same thing. Right? So as I learn more about the region that it's in and the neighborhood that's building up, nothing changes about the business model. No new information about what's going on here invalidates anything I already know, which means I know something, and then I know something more, and then I know something more. My knowledge is monotonic. It goes in one direction. It only increases. That's exactly what I want. Let's take AI. And let's say that you analyzed the AI industry in early 2024. Too bad. that information is dead. Because we're in June of 2025. Right? And even if you said, well, look, I got a report, I wrote it in January of 2025 in AI for the model. That's history. It's over. It's done. It's very possible that your knowledge is non-monotonic, which means you learn something, and as the industry evolves, it can obsolete the knowledge you had or even invalidate the previous knowledge you had, which means you must always stay on top of this all the time. The environmental scanning that you need to do is off the charts. And your visibility into the future, it's going to be a month into the future, a couple of weeks into the future, because all it takes is a new architecture and this whole industry falls apart. Right now it uses a transformer architecture with LLMs, and reasoning models are built on top of the LLMs, and the reasoning models just do chain of thought, and then with each one they then go to the LLM. So it's all just still pattern matching, which means it's going to have this kind of pattern. Right? And we are here right now, and everyone's saying, super intelligence, but they're forgetting that technology has an S-curve. It always has an S-curve. You can almost say that is a law. And then you get another technology that starts up that is not as efficient as this technology, but it tends to do this. And then the next technology tends to do this, and technology progresses in S-curves like this, and we are... some are saying we're already seeing this going on. Well, you got to be on the lookout for this, because this will obsolete all of this. And then you got to be on the lookout for this, because this will obsolete all of this. So it is non-monotonic, which means your knowledge is in danger of being obsolete when you start. But my knowledge of reach from 20 years ago still applies today. It's monotonic. I can only add to that knowledge. It's going to be difficult to come up with a new model that replaces the REIT model, a new technology where you say, renting apartments is dead. That's over with now. Renting office space is gone. Renting malls are gone. Data centers, they're gone. Like, it's going to be hard to do, right? So you can pick, if you pick something like that, it's constant. You can't stop. And you'll realize that what you knew 5 years ago doesn't apply anymore. And then something as fast moving as AI, as robotics, as autonomous driving, stuff you knew a year ago, chances are you're out of date. It's your pick, right? Do you want something like retail, hypermarket retailers, the Walmarts, Costco's, things like that? That's a fairly stable business model, where in 5 years you'll be much smarter than you are today, without risk of a lot of obsolescence of your knowledge. But if you jump into AI, for example, or even cybersecurity, you risk that non-monotonic effect on your knowledge, in that it's not going to be cumulative. Is that something may happen which says, everything I knew, it's gone. I don't need it anymore, and what a waste of time that was, right? You're in early 90s, and you've learned WordPerfect. You're a whiz at WordPerfect. Except Microsoft Word exists and WordPerfect doesn't. All of that knowledge is obsolete. So, it is, it's a choice. Any thoughts of this? I already answered that. And what does it mean when someone says beat the market? Well, it means they have a benchmark, right? Some index which has components in there, and that's their benchmark, and they're going to try to beat it, which means true to that benchmark, you are investing in this style. So you wouldn't say, here's the S&P 500, that is my benchmark, and I invest in bonds. Well, then this is not your benchmark. So that's what it means by beating a market. It means beating your benchmark, whatever that benchmark happens to be. Since you generate much returns for yourself, then what would have got... since you generate much higher returns for yourself than what you would have got if you had invested in just an index that tracks the market, can I say that you beat the market? I get asked this a lot, and my answer is always the same. I don't know. I can't tell you, because I have to then say, do you want me to just compare it to the S&P 500, even though I invest in currencies, I invest in commodities, I use options, I invest outside of the S&P 500 index? The S&P 500 at that point seems to just be a random choice. If it's a random choice, well then let's take a money market fund. Why can't we just be that random? Yeah, I beat the market if it's a money market fund. Yeah, I beat the market if it's a bond market. I mean, why favor one index like the S&P 500 when I invest in Canadian banks, Canadian utilities, Canadian REITs? Does it still make sense to use the S&P 500? So when somebody says, "Did you beat the market?" Which market? Which one? Which index are you referring to? And if you say S&P 500, my question would then be, okay, so do you want me to eliminate everything in my portfolio that is not in the S&P 500 and just answer the question of the components of the S&P 500 I invested in, did I do better than the index? So it becomes a difficult question to answer when you're talking with experts, because experts will call you out on that right away. Yeah, I beat the S&P. Yeah, but you're investing outside of the index. That's not fair. Well, you're right. But for somebody who is naive or uneducated about what that means, they would say, "Oh, you're dodging the question." No, I'm not. No, I'm not. If you knew what I knew, you would realize what a difficult question that is to answer, because we must first determine, well, what do you mean by the market? And is that a fair benchmark for what I do? So for what I do, a better return is usually a risk-free rate plus a spread. And typically, this is what you do with hedge funds: a risk-free rate plus a spread. Private equity hurdle rate's about 8%. Most hedge funds hurdle rate is about 8%. So you just put on the spread. The higher the risk of the strategy that you follow, the higher the spread would be. Because hedge funds can do anything they want, follow any strategy they want. So rather than a market return, it would be some benchmark return, like a risk-free rate plus a spread. If anyone can beat the market, well, no, that's not true. Then why don't people just invest in index funds? If anyone can't, I think you mean if nobody can beat the market, then why don't people just invest in index funds which track the market and chill? A lot of them do. Passive investing, which is exactly what that is, has risen a lot. Why are they giving money to underperforming money managers? Lack of knowledge about what to do. Many people, if you say, well, just buy the index, what does that mean? How do I do that? Do I do that through this broker? They wouldn't know how. So for a majority of people who aren't in the finance industry, they don't know any of this stuff. They don't want to be involved in this stuff, right? What do you mean by timing the market? Is it possible to do that? I don't think so. Timing the market means, it's 2:30. I think the market will sell off, so you take a short position. You're trying to time it. That doesn't work. What do you mean by pricing out? In live, you said something like bonds pricing out. Well, pricing in means that you are taking some event and having it reflect in prices. So if risk increased and the market equities dropped, you would say equities are pricing in that risk by lowering. Pricing out means that it priced in the risk. The risk doesn't go away, but the market rises. You would then say, well, the market's just pricing it out. It's taking that risk out of the market. When I said market is down 0.22, you said it's a normal 2. Well, 2.22 is nothing. I mean, it's nothing. What percentage of the market be down to be? Well, I don't know that there's a number that we all agree on, but when we say the market is down, you'd want to see some significant down, 0.9, 1%, 1.1. You'd say, okay, we're down, but 0.22 is like, it's, I don't know that that I'd say here's the number. Just it's, you can eyeball it and say, it's nothing, right? More questions. Please tell me whatever I'm writing down will even be considered an analysis or not. U.S. bombed Iran. So it's bad news. So every sector, every stock except defense must be down, as all of the sectors except defense are connected with each other. So if one sector gets affected, others will. That's not an analysis, no. No, it's not. That's not an analysis. I don't know how to answer that question. I really don't. I would say that that's a sentence that doesn't tell me anything other than a guess. Is it a guess? I don't know, but that's certainly not an analysis. Before you did live U.S. bombed hours before, the day before, not hours before. So why, when the markets opened, it did not go down? It is as bad news, so it must or should go. Well, I thought, it warranted more red for longer than what we had, but it was like a minute and a half that it was red, and then it started going back up. It was down 60 points, 50 points, 40 points, 30 points, 20 points, and the market just concluded that, well, this is an event. And all of these geopolitical events usually disappear anyway, so this one will disappear. So if it's going to disappear, what are we waiting for? Let's make it disappear now. And it didn't even price it in, really. I mean, the next day you had a rally, and everything is solved and everything is done. But it's hard to answer a question like that because we don't have linear markets. It's not as if A leads to B. It's A leads to B sometimes. Sometimes it doesn't. A could lead to C, A could lead to D, A could lead to E, maybe, but maybe not. There's a lot of really conditional statements, and a lot of abductive statements, meaning generally speaking, when this happens, we usually expect to see this. And that's about the best that you can say. And if we don't, it must be because of something else. And that's about the best we can do. Is it like the market decides? Well, the market doesn't decide. It is the collective action of all the participants. The market is just a term we use for all those people. The market has no mind. It doesn't decide. So market participants decide if it will give any kind of importance to any conflict happening anywhere in the world, or are there any criteria that this conflict will get Okay, I can see that you're very, very far away from a level of knowledge in this industry. So even though your questions are seeking knowledge, they're so far away from where you need to be that I would say, because whenever I see your name, you always have these 5, 6, 7 questions. I would say maybe tone it down on the questions and get some formal education in this field first. I'm not going to help you with the answers I'm giving you because your questions are so far away from where they would be that to get you to where you are, I would have to have a seminar just for you to explain so much that I would say, don't stop being curious, but your questions are just too far away you really should, I think, focus on getting some of the basic groundwork knowledge behind you first. And many of these will start to clear up as you learn that. But learning by questioning, especially these questions, aren't going to help you very much. Many of the answers just are intuition and experience that really have no words. So we'll just skip over these. OMG, it's you. I don't know. Oh, Michael Saylor. Is this Michael Saylor? M. Saylor. There are books that flip the cost to carry formula. So when you said negative carry, you mean benefits minus cost. No, negative carry means it costs you money. Just think about it that way. Negative carry means that you will underperform the underlying. Positive carry means you will outperform the underlying. Let me show you what that means. This is the spot price. Okay, that is today. If you look at the front month futures contract, let's do this. It can either be below the spot price or above the spot price. And you have the spot price, E to the R minus, well, we'll say minus the benefits plus the costs. We'll just do it that way, right? So the higher the costs, the higher the futures price. The greater the benefits, the lower the futures price. You take a stock which has no dividends, it's simply just going to be higher, right? So that means the further out you go, the higher the price will be, right? This is called contango. And if the front month contract is below the spot price, usually you'll have something like this. This is called backwardation. Okay, let's look what happens. Let's say that the spot price increases to here. Well, let's say it increases to here by the expiration date of this contract here. So this earned this much, but the contract only earned this much. In other words, you underperform the spot price by this much. This is the cost of carry. However, if it's in backwardation, it earned this much. It outperformed the underlying, so you have positive carry because you beat the underlying. You got something extra. Here, you underperformed the underlying, you lost something. So that's when we say negative cost of carry. It means you will underperform the underlying spot price. No matter what the spot price does, you will underperform it. Just to go the other way, just to show you that that's true. Let me back this out here. Where are we? And let's say that this, by the time of expiration, fell all the way to here. So the spot price lost this much, but if you bought in backwardation, you only lost this much. So you outperformed by that much. You didn't lose that because you already had a lower price. Whereas if you had a contract in contango and the price dropped, you lost more. How much more? This much. So that's why this is negative carry and this is positive carry. Anything where the futures price is higher than the spot price and the futures price, the further out you go, is higher, has negative carry. Anytime the futures price is lower than the spot and the further out you go, the futures price is lower, has positive carry. You want to buy positive, sell negative if you can. Usually what traders do is if they pick something like this up, which has negative carry, they will buy here and they will sell at the back of the curve. They'll be short the back of the curve, they'll be long the front of the curve. And why would they do this? If you get a stressed market, what's going to happen to the spot price? The spot price is going to climb. Well, what it's going to do is it's going to pull these prices up, but not by the same amount, right? So that you will end up with a curve in backwardation because the spot price will pull the forward curve up, but not the long end, and you'll create backwardation. There's your long, there's your short, and as each day goes by, you lose carry, you gain carry. You lose carry, you gain carry. In other words, you have no carry. You're long and short the carry, and you're hoping that in a stressed market, the front month will increase, but the back month will stay there. You're not really making any bet against the back month except you're offsetting your negative carry with positive carry. That's a very popular trade. More information than what you need, right? Can you explain again how we lose the $5 by rolling over? 5 cents per pound by rolling over. Because the distance to the next contract would probably have 5 cents per pound of carry, and the distance to because they're all 90-day distances, right? They're all 90 days, so they should have a fairly constant 5 cents per contract. I mean, you can look at the forward prices, the futures prices on copper, and you could say they're all about 5 cents apart. Yeah, roughly. I mean, I didn't do the calculation to get to the exact number, but do you think your copper thesis is only profitable if access to leverage is possible? Nope, 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 no. It's even if you de-lever, it's profitable. You just do better with leverage. Since you're an expert and consume ample amounts of knowledge and intelligence, do you get annoyed by this type of naive question? I don't get annoyed by uninformed questions. If you are uninformed and you're seeking to be informed, those questions don't annoy me. The questions that annoy me are lazy questions, where you don't need me to answer the question, you're just taking up my time. What does this word mean? Look it up. Look it up. Just look it up. You've got how much technology sitting in front of you, because you're clearly typing the question into, watch the video online, you're typing it in. There's a thing called Perplexity or Google or anything. Look it up. I do get annoyed with the lazy questions where you can simply just look it up yourself, right? And now, more so, if somebody says, I don't understand this term, maybe you can't look it up. Maybe you don't know where to look it up, but that doesn't matter anymore with AI. Whatever question you have, ask AI first. For a lot of declarative and conceptual things, AI is pretty good. AI will get you 90% there, right? So it's not the naive questions. It's the lazy questions I don't like. I think the counter argument for rate cuts is the amount of liquidity in the equity market. Based on Howard Marks' definition of a bubble from his memo put out in the winter, it seems that we could be in a bubble. I'm pretty sure we are in some areas. We're bubblicious or bubbly. I don't think it's the amount of liquidity. You had lots of liquidity. Japan put out lots of liquidity, right? So it's and where was inflation in 2010, 2011, 2012, 2013, 2014, 2015, 2016, 2017, 2018, 2019, 2020? I mean, where was it? All right. So it seems that we could be in a bubble. I'm seeing ridiculous multiples on companies that are not real businesses. Even seeing ridiculous multiples on companies that are real businesses that really don't justify the multiple. Marx argues bubbles is psychological, not statistical. I agree with that. Irrational exuberance, yeah. Adoration of certain assets, I agree. FOMO, yeah. I think that's what we have in the equity market now, is this fear of missing out. I think this a narrative of all-time highs has gripped the market, and everyone and now this belief is we're going to all-time highs. So we're going to all-time highs only because the market believes we're going to all-time highs and no other reason. Multiple expansion, not earnings expansion, not economic expansion, because our first quarter GDP was negative. You have headwinds showing up. It is pure multiple expansion. Why? Because people believe we're going to hit all-time highs. Why? Well, because we're going up and we're going to hit all-time highs. But the drivers of typical all-time highs aren't in place. So I agree. We see fear of missing out. Belief that there's no price too high. That's true. Widespread participation by non-professional investors. Yeah, you do have that now, but that's almost a characteristic of the market today as opposed to, 1929 when it was odd. 1999 when everyone was talking about it. 2020 when everybody was just saying crypto, 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 crypto everywhere. And today it's AI, 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 and I think that's going to be a major letdown. Not because it's not good. it is fantastic. But this idea of super intelligence, remember, you have these technology curves that look like this, and this is where we are. Some are sort of thinking that we're already here. But the risk in these curves is to say, okay, well, look, we hit this trajectory, OpenAI, then all these models are coming out. In the last 3 months, they've really accelerated that this is the projection without realizing that these always do this. They always do this. And where we are now, this line here is metacognitive, the metacognitive domains. So as far as knowing the facts, understanding the facts, and applying the facts, yeah, it's going to become killer at all of this stuff. But that's as far as it goes. Why? Because it's code. Code has no mind. It has no conscience. It cannot reflect upon itself because it has no existence. It's simply just code. You have a couple of really high-end people in the industry. One, a Turing Prize winner, Jan LeCun, who's saying the current technology, the transformer technology, says it is inevitable that it will flatline. He says this is not the technology for general intelligence. And you have another neuroscientist. If I could find his name again. It's right at the tip of my tongue. I listened to him and I thought, okay, I really like what this guy has to say. He has been working in the field of AI for some time, but he started as a I think he's got a PhD. I think he's at MIT. But he's very critical of this, and he's saying this is what's going to happen. And you have a couple of math PhDs saying we could have told you this back here. We could have told you that this is going to happen. And I think that almost any historian of technology would say, if you don't get an S curve, this will be like historical. If you don't get an S curve, they're all S curves. And I think this is what we're going to see, and I think that's going to be a big problem. So AI, we could say AI is a bubble. But if you go back to 1999, here's what we had in 99. You had this massive exuberance about the internet. And you had all of these sites showing up. Every day you had 1 to 2 IPOs every single day, and it would go out at $100, and by the end of the week they're trading at $300. It was stupid and ridiculous. Everyone was in there. And you had, again, it always does this, right? And this is 1999. And everyone was rushing to get in because the idea was, you got to get the eyeballs, the money will follow. Get the eyeballs, the money will follow. And all these stories about how it's going to change the way we live, the way we interact, the way we work. Offices were dead. Everyone's going to work from home. Universities are dead. Everyone's going to study from home. I mean, bricks and mortar were going to disappear. That was the story. Now, at the time, you could see that, yes, this will introduce some new business models and challenge some existing, but disappear? Come on. And then, of course, it tapered out. Because the reality showed up that, well, hang on a second, it's not going to do this, and it was pricing in this. It was going to do this. And then from here, it was going to do this incremental stuff for years until Web 2.0 came along, right? Which put a new layer onto the internet. This whole idea of social media. That wasn't even a thing in the 90s. Well, I think you had mobility first, then you had social media, you had these waves of curves that then had more and more implications, new business models, new businesses come along, old ones disappear. It all has these issues. So in 1999, you had the same story, right? Cisco's going to the moon. It's never going to stop. Microsoft, Dell, all these hardware companies that are building out the backbone of this are going to the moon. It's not going to, all these .coms are going to take over. And the telecoms were on fire because everything's going to run over those wires. And it does this. AI is due for a bust at some point in time when we realize that the transformer model is got its limitations. It's going to have diminishing returns. Now, what it will be will be killer. The LLMs and the LRMs at what they do will be killer, but they'll get incrementally better and better and better and better, but they will not get to this level until you have a new technology that at first appears insufficient based on where the existing technology is, but it has the potential to get much higher. Now, where could that be? It could be the combination of a new type of data structure combined with quantum. That would take all of this and say, that is all garbage now, right? So are we in an AI bubble now? It certainly feels like it. It certainly feels like it. Interest on your view of the federal student loan issue. Yeah, it's becoming more of a problem, right? Powell advocated for forgiveness this week because it would relax some pressure on retail credit, given the long spree of inflation and elevated rates. Yeah, I didn't hear his argument for this. I was out looking at Range Rover Defenders today. Do you know that Canada, that some of these Defenders are as much as 190,000 Canadian? 190 grand. I was looking at one, by the time you get all the taxes in, walk out the door, it is 140. It's a Defender X. But I like the look of those things. It's matte black. That's an extra $5,200. It's called a wrap, a matte wrap. It's not really a paint, it's a wrap. It's an extra $5,200 to get that done, but I was out looking at that, so I missed all that today. But let's see what his argument is. I'm not convinced it would have any long-term benefits. All retail credit stress is from the same archetype. I don't know that you'd call this retail credit. It's student loans. Usually they're wrapped up and sold, and there are bond holders, and the student loans back that. Same person who buys a car they can't afford is the same person who maxes out their credit cards, is the same person who took a COVID check and spent it on new shoes. The one-time GDP growth from enabling financially irresponsible people to deleverage for free and subsequently re-leverage doesn't solve the actual problem. Not to mention, it would be a massive net loss given the $2 trillion of outstanding federal student loan debt. I'm not going to disagree. I think that there are a lot of individuals that want a lifestyle, and they're going to buy that lifestyle no matter what it costs them. And I think there's a lot more people that live on at the extent of their credit to maintain a lifestyle than you could believe. I think there's a lot more that do that. I think there is a lot of quiet desperation behind closed doors while you're looking your best in front of your neighbors. You know, and I think all the neighbors go in and live these lives of desperation, of financial desperation, saying, how are we going to make it? Well, we're just going to get by. Let's see if we can get a credit increase on this. Let's see if we can do that. I think there's a lot of people who do that. For someone like myself who went to public in-state schools strictly on bang for buck, got a valuable degree, paid off my debt in 2 years, it is frustrating to hear this. Am I taking this too personally? Do you agree with Powell here, or do you have another view? Student loans. This one here is a tricky one. I'm all for evicting people out of their house if they're not paying their mortgage. I'm all for that. Yep, go ahead. I have an asset, the house. I can take the asset and I can sell the asset. I can separate the asset from the individual. Same with the car. You're not making your car payments. We repossess the car. We can sell the car. But I cannot repossess your education and sell it. It is intrinsically tied up with you. So when we repossess a house and we sell the house to pay off the mortgage, if there's anything owed, if the bank writes it off, then fine. That's a private loss. The bank writes it off. There is an asset that can be taken and sold. There is no asset here. So if we give them forgiveness, what we're doing is we're getting everybody here to pay for that education for this group of people who then end up earning the private benefits from that education because they take the asset with them. So you're socializing the cost but privatizing the benefits. That's the problem I have with paying off student loans, is that you are privatizing the benefits. If there is a problem with the student loans and you do pay them off, then I would say, well, then that's fine. Here is the average income in society. This would be GDP divided by N. Here is the median income. Anything above a median income would go to pay back what we wrote off. It's not a tax. It's paying it back, which means that we'll allow you to live this. Go ahead, and you don't owe any money, and you can live the life under this income. But because you got the private benefits, if these private benefits start accruing to you, let's not forget that society helped buy that asset for you, because on your income statement, on your economic, not income statement, your economic balance sheet, not your accounting balance sheet, but your economic balance sheet here is the present value of all your future earnings. It is an asset. Education makes this asset larger. That is your asset. Can't repossess that asset. So if society is gonna pay it off for you, society is placing an asset on your balance sheet. Doesn't society have an interest in the asset? So rather than make society make society pay for it, rather than having debt, you want to get rid of the debt on this side, which is student loan. Okay, let's get rid of the debt, and we're going to take an equity position in your life such that some of the present value of that cash flow over a certain amount belongs to society, because society paid for it and you walked away with the asset. That's the tricky thing about the student loan. That's why, at least in Canada, if you declare bankruptcy, it does not invalidate your student loans, because when you declare bankruptcy, your assets are liquidated. Can't liquidate this asset. So it would be unfair. Everybody would go and get an education, the most expensive education, and immediately declare bankruptcy on graduation if it went away. And you'd have an inefficient market for student loans, because no one would lend money against that. So you can't ask the bondholders to take the hit, because now the government is determining who gets to win and who gets to lose in society in the private sector. I'd be afraid of investing in anything for fear the government comes along and says, you know what, you're not going to get your money back. You take the hit. We're going to make sure these people don't have to pay you. They tried that with apartments during COVID. You can't kick a tenant out if they're not paying you rent. Can't kick them out if they're not. You can't repossess that house if you're not getting your mortgage payment. Without thinking about all the landlords out there that suddenly have to say, well, how am I going to pay my mortgage? My bank's not giving me a break, right? This one here I'm torn on, because if you take a student who graduated who does not have a job, they got to start paying that debt. How are they going to get that shit done? They're going to have to take a whole bunch of jobs that they don't want just to make the payments. Well, while you're working all those jobs to make the payments, you can't be out there looking for the job you really need. So it is a bit of a problem. But across the board loan forgiveness, no. I'm 100% against that. Some kind of workout, like I just described here, okay, let's work something out. But this forgiveness, let's make the taxpayer pay for it, but let's privatize the benefits. So these people get all the benefits of their education, and everybody pays the costs. You could say, but they get a benefit because if these people make more, they pay more in tax. Yeah, but they would have paid more in tax anyways. Like, that's not an added benefit. They would have paid more in tax anyways. I don't agree with loan forgiveness for this particular thing, for the very basic reason is that you cannot repossess the asset. The person owns the asset. It's inseparable from the individual. The debt must be inseparable from the individual as well. Do you agree with the Republican Senate's example of car prices falling data to back the interest rate cut argument to Powell? I don't know the argument, but if prices are falling, if you're not seeing inflation, what the hell do you need 4.33% money market or overnight rates for? What do you need a real rate that high for? You don't. 2.5%. If you got, if you got 2% inflation target, 2.5% is your overnight rate. We're at 4.33, and annualized going back to the last 4 months, you're below the Fed target. We don't need rates this high, but Trump fucked it all up by demanding that they cut rates. So now they can't cut rates, because if they do, the market will interpret them as being as leaning towards the political pressure and ignoring their mandates, and yields on the long end would go even higher. Trump did this himself. He even admitted that. So we would have already had, I think Bloomberg talked about it this morning, would we have had a rate cut? No, they didn't, sorry. They talked about April 9th. Would we have had a rate cut if April 9th had never occurred, day of liberation? And the general consensus was, yeah, we would have had a rate cut already if that never occurred. I seem to think we would have had a rate cut if Trump never opened his mouth. Even with the tariffs, if he never opened his mouth, we'd already have a rate cut. I'm of that belief. But pointing to one item falling in price, that's one item falling in price. That's not a general decrease in the price level. That's just one thing falling in price. You could get that simply with just a greater supply of vehicles, So, said that, I still like your analogy of the ship sinking and the cook saying, not my job to get rid of water. Yeah, that's kind of what Powell is right now. He's the cook on a ship filling up with water saying, not my job to bail water. Like, the interest on the debt's not my problem. It's the economy's problem, so it is your problem. It's just you're not forward-looking enough. Have you used the LLM itself to generate a prompt and not writing one for you? Yeah, but here's what happens. Write me a prompt for this, and it does go, nah, it's not going to get it done. Write me a prompt for this. The audience is going to be this, and I want the LLM to take this persona. And it writes it, nah, it's not good enough. So by the time I write a prompt to get the LLM to write a prompt, by the transitive property, I don't need the LLM to write the prompt because I've written the prompt for the LLM already. It doesn't really work that well. It doesn't really work that well. So you end up just writing the prompt yourself. So yes, I have tried, and no, I don't like what I get. Anyways, that's it for this week.